Hi everyone, welcome back to this week's Technical Insights. Singapore STI Index ended last Friday, 17th of November, down 8 points or 0.27%, while the Asia-Pacific region indices turned in a mixed performance. Across the broader Singapore market, losers outnumber winner 310 to 294, with 928 million securities worth 676 million changing hands. Japan Nikkei 225 was the best performer in the Asia-Pacific region, rising 0.48%. Shanghai Composite Index was also up 0.11%. Hong Kong Hang Seng Index was the biggest loser 2 weeks in a row and sliding down 2.12% after the 1.76% drop last week. This slump was attributed to Alibaba's group's worst sell-off in more than a year. The company scrapped a plan to spin off its cloud computing business amid heightened tech war and cybersecurity concerns. Alibaba plunged 10% to Hong Kong dollars 73.25, the most since an 11.4% drop in October last year. The sell-off erased more than 21 billion from its market value, in addition to a US 20 billion drop overnight when its American depository shares crashed 9.1% in New York trading. The stock came under pressure after founder Jack Ma Family Trust, JC Properties, and JSP Investment each disclosed a plan to sell about 435 million worth of shares on November 21st, according to US exchange filings. For the week, all three major US indices notched their third straight positive week. The Dow Jones Index added 1.94% to close at 34,947 points, while the S&P 500 advanced 2.24% to end at 4,514 points. Tech-heavy Nasdaq was the top performer for the week, rising 2.37% to finish at 14,125 points. The higher-than-expected weekly jobless claim numbers without a doubt added optimism to calls that the US central banks would not need to tighten again. Those gains were sparked by tame US inflation data midweek that gave hope to investors that the Federal Reserve's tough stance on rate policies may be in the rearview mirror. So it does appear likely that we are going to finish with a bit of a Santa Claus rally in the US market. In Asia, the CSI 300 index was down 0.51% to 3,568 points. The Hong Kong Hang Seng Index managed to close positive for the week, up 1.46% to 17,454 points. On our local front, our STI Index added 0.58% to end a short trading week due to the Deepavali holiday last Monday. Locally, our three local banks also turned in a mixed performance for the short trading week. DBS was the biggest loser among the three banks, falling 1.45% to $32.69. UOB lost about 0.18% to close at $27.35. OCBC more or less ended flat for the week to close at $12.97. For SGX, the shares fell 1.75% for the week after gaining 1.89% last week to finish at $9.54. The biggest winner for last week was Genting Singapore, up 10% for the week to finish at 93.5 cents. And the biggest loser was Yangzijiang Shipbuilding, down 2.01% for the week to finish at $1.46. So for this week's technical analysis, let's look at both of these counters. First, let's look at Genting Singapore. The company announced Q3 net profit up 59% to 260 million the Friday before after the market closed. When the market reopened last week on Tuesday after the Deepavali holiday, the stocks jumped by 11.8% in heavy trading on Tuesday morning. For the week, the stock is still up 10%, holding on to those gains on Tuesday. Looking at the charts, the stock year-to-date high was seen on 4th of April at $1.15, and the year-to-date low was also seen recently on 6th of October at 81.5 cents. The stock tested the 200 days moving average, which is the red line that you see here, but did not manage to close above that 200 days moving average on Friday, which will be a big bullish signal. The 20 days moving average, which is the white line in between the Bollinger Band, cut above the 50 days moving average on Tuesday, a sign of short-term rebound in play, and the stock could have bottomed out at the double bottom formation on the 6th and 23rd of October at the 82 cents level. Looking at the MACD indicator, the gap between the MACD line in blue and the signal line in amber is still quite significant. and a sign that the positive momentum is still very strong and the uptrend may persist further. On the RSI, we peaked on Wednesday, 15th of November at the reading of 72, which is regarded as the overbought level. Hence, the pullback towards the later part of the week wasn't unexpected. The latest RSI reading last Friday stands at 64, which is a healthy reading that the momentum is still pretty strong. So with both the MACD indicator and the RSI showing positive uptrend momentum, investors can look at the 27 October high at 89 cents, having a positive change in polarity from resistance to a support level for a primary re-entry into the uptrend of Genting Singapore. Or for a more conservative play, the 20 days moving average in white and the 50 days moving average in yellow, which is at 87 and 86 cents respectively, could also be level of strong support for the uptrend to continue. Next, for Yangzijiang Shipbuilding, the shares was down 2.01% for the whole of last week. The company shares hit a high of $1.56 the week before, up 13.87% from the 23rd October low of $1.37, which we covered in the 23rd October video. The stocks now hover around the 20 days moving average, which is a white line that you see here, at around the level of $1.47. Unfortunately, the stock closed below that 20 days moving average level at $1.46. The 200 days moving average, which is the red line that you see trending upwards over here, is now at $1.39, and it still provides good support for Yangzijiang Shipbuilding stocks. But the RSI is now below the 50-point neutral mark at 41 now, so the upper bound of the Bollinger Band at $1.54 will be the target resistance for now. And this level also coincides with the 7th of November high at $1.56. So we do expect a lot of resistance on the upper bound of the Bollinger Band between the $1.54 level and the 7th November high of $1.56. The MACD indicator is still positive, but the gap between the MACD line and the signal line is narrowing, indicating that the positive uptrend momentum we observed earlier is subsiding right now. For traders that managed to get in on the 23rd October low at $1.37, you will still be in the money right now. And you may consider accumulating further around the 200 days moving average level, now at $1.40. For traders that missed the earlier low on 23rd October, the 200 days MA at $1.40 may be a level for you to look at for a long position to target the 7th November high of $1.56. And that's all I have for this week's update. As usual, if you find this video useful, we appreciate your support by giving us a like or a share and hit that subscribe button to stay up to date to our latest content. And I'll see you again next week in the next Technical Insights.